I'm John Lesky, recently retired personal financial planner and founder of finhealth, a tool to guide you to your financial independence. Now, many financial commentators suggest that the ongoing falls in interest rates since the global financial crisis have hurt the savings and income expectations of retirees in an unprecedented way. Some, like this recent Sydney Morning Herald article, consider that a potential solution is for retirees to increase the percentage of their investment portfolios held in growth assets and, consequently, reduce the amount held in defensive assets. It's argued that this offers the prospect of higher returns on increased growth assets to offset lower returns on reduced defensive assets. We don't like this proposed solution. The purpose of defensive assets is to reduce the volatility of your investment portfolio and ensure you can sleep well no matter what share markets are doing. It's not to generate high investment returns. The selection of a target growth asset allocation ratio was explained more fully in our video, The Growth Asset Allocation Ratio. It's our view that you should never increase your target growth asset allocation beyond a level that is likely to cause you considerable anxiety in the event of a significant fall in share markets. We're also not convinced there is a problem, yet, of inadequate total returns from investment portfolios. In the 12 months to end June 2021, low actual returns on defensive assets have been more than offset by stellar returns from share markets. This should have resulted in many retirees selling growth assets to rebalance their investment portfolios, rather than adding to growth assets to enhance already healthy portfolio returns. But in the rest of this video, we want to further examine the commonly held view that investors in defensive assets are currently facing unprecedented low returns. The chart shown on the screen now shows the movement in the 3-month bank bill rate from September 1969 to March 2021. The bank bill rate is a proxy for returns to sophisticated investors in defensive assets. The chart supports the conventional wisdom that rates are at unprecedented lows. Rates rose dramatically from around June 1973 to remain well above 10% per annum for most of the rest of the 1970s and the 1980s. Then, from the early 1990s to late 2008, they hovered at around 5% per annum or higher. Since the global financial crisis, they briefly touched 5% per annum in mid-2011 and have since fallen precipitously to a March 2021 level of 0.02% per annum, virtually zero. The chart on the screen now adds a 5-year rolling return to the previous chart, showing the 5-year return experience of an investor who rolled over their bank bill-related defensive investment assets every 3 months. For the 5 years to March 2021, they received a paltry 1.35% per annum. This compares very unfavourably to the peak 16.3% per annum for the 5 years to June 1990. But these are not the returns investors should focus on. What matters is after inflation and after and tax returns. This is the real purchasing power that any investment provides. The chart on the screen shows actual interest rates adjusted for inflation, as measured by the Consumer Price Index. These real interest rates would have been available to investors that had access to a zero tax environment, for example, the pension phase of superannuation. Real interest rates have fallen from a maximum of 9.6% per annum in December 1989 to minus 1.09% in March 2021. Undoubtedly, this has hurt retirees and others relying on returns from defensive assets to finance a desired lifestyle. But if it's any consolation, the current experience isn't unprecedented. The retiree of the 1970s saw inflation eat away the value of their fixed interest holdings for an extended period. The next chart overlays rolling 5-year returns on the previous chart to show 5-year real interest rate experiences. The maximum 7.15% per annum for the 5 years to December 1989 significantly exceeds the minus 0.06% per annum for the 5 years to March 2021, but the 7.09% per annum decline is significantly less than the 10.69% per annum decline in actual interest rates. The minus 3.01% per annum after inflation return for the 5 years to September 1977, compared with an actual return of 9.6% per annum, is an experience most retirees would not want to see repeated. Finally, in the chart now shown, we examine the after inflation and after tax experience, assuming the company tax rate of 30% for investors. These after-tax real rates have varied from a high of 7.3% per annum in March 1985 to a low of minus 8.6% per annum in March 1975, with March 2021 at minus 1.09% per annum. 5-year rolling rates are shown on the next chart. While a rolling return of minus 0.28% per annum for the 5 years to March 2021 is disappointing, compared with a peak of 5.11% per annum for the 5 years to March 1993, it is much higher than the minus 4.22% per annum experienced in the 5 years to December 1977. The bank bill rate is a base cost for borrowers. The minus 4.22% per annum 5-year rolling return to December 1977 received by investors implied that corporate borrowers were actually making money on their borrowings after tax and inflation over that time period. Our message is that actual interest rates may not be the best guide to investors' after tax and after inflation returns, and these are the returns that are important. Actual rates may be fooling investors into thinking they are doing better or worse than they really are. This can result in poor financial decisions. For example, taking more investment risk than the investor is comfortable with, or taking poorly understood risk in the quest for high returns. But even after correctly allowing for inflation and tax, it's clear that interest rates have fallen dramatically from the levels experienced in the 1980s and 1990s. It is our view that these years are likely to prove the anomaly, rather than the 0 to 2% per annum after inflation and after tax real interest rate returns experienced since the early 2000s. And certainly, what we are currently experiencing is not unprecedented. I'd like to know what you think about current interest rate returns and how they're affecting your investment decisions. Please provide any comments or questions below. And finally, thanks for watching.